The global economic situation is currently uncertain with countries like China, or should I say, the whole world who battled the recent COVID pandemic, the war between Israel and Palestine, and the threat of nuclear war hanging over our heads. As Bob Dylan once said, we must bring it back home, where we will discuss what's going on in the US. The US is the world's largest economy, and any downturn in it will have an impact on the global economy. This is crucial to keep in mind. Welcome to Financial Literacy. Here, we are dedicated and passionate about bringing you nothing but honest and straightforward facts about your money. We will help you take control of your finances and get you to the next level. Beginners or experienced, this is your one-stop shop for all things financial literacy. We are heading towards a severe recession, and in this video, we will be discussing the dynamics behind it with insights from expert Jim Rickards. But before we delve into that, let's get a brief overview of the current situation and understand the impact of the impending US recession on the world economy. With that in mind, let's jump right in. Meet Jim Rickards, an expert on finance and economics with over 40 years of experience. He has advised the US government, the World Bank, and even the CIA on financial threats and is an expert in understanding the economy's complex workings. In this video, we will be delving into his insights on the impact of the US recession and how it could affect us all. So let's get started and explore the intricate workings of the impending US recession. Understanding the dynamics of a severe recession. The Federal Reserve is important to the American economy, as we already mentioned. The Fed's main duty is to control the country's monetary policy to maintain stable prices and maximum employment. This is accomplished by managing the money supply, altering interest rates, and monitoring banks. The Fed, however, hopes to slow down the economy with the announcement of the interest rate increase to prevent inflation from growing too quickly. Although it could appear like a sensible option, it might harm the economy. A rising interest rates influence on consumer and commercial loans, which results in higher borrowing costs, is one of the most obvious repercussions. Therefore, businesses have less money available for spending, which results in a decline in investments and job openings. Additionally, as firms see a decline in profitability, the government also sees a decline in tax revenue, which causes an increase in government debt and deficits. But that's not all. Inflation too can rear its ugly head during this time. The value of currency decreases, leading to a rise in prices, making it more difficult for businesses to keep up. We both feel the inflation getting the best of us, right? Quite troublesome indeed. The impact of all this on individuals cannot be ignored either. People are cautious about spending and saving money, and with businesses hiring fewer employees, the job market takes a hit too. All this, coupled with the rising costs of consumer goods, can lead to a severe recession that can have a lasting impact on the economy. So while raising interest might seem like a sound decision on paper, it can lead to a snowball effect that can wreak havoc on the financial stability of the country. In the next section, we will look into historical precedents and warning signs to further understand these dynamics. Historical precedents and warning signs. As the saying goes, history repeats itself, and that is no exception when it comes to severe economic recessions. We have experienced numerous drastic economic downturns throughout history, from the Great Depression to the 2008 financial crisis. These recessions have had far-reaching effects on the global economy and have taken years to recover from. The signs of an impending recession are often present well before the recession hits, and it is important to recognize these signs to prevent or mitigate the potential damage. One of the most telling signs is an inverted yield curve, where the yield on long-term government bonds falls below that of short-term bonds. This has occurred before every recession since the 1950s. Other signs include rising unemployment rates, declining GDP growth, and a slowdown in manufacturing and consumer spending. It's vital to stay aware of these red flags and take practical steps to get ready for the incoming economic slump. This means taking a thorough look at your finances, working on clearing your debts, and setting up an emergency fund. For businesses, it's equally essential to review their financial health and make necessary changes to toughen up against a recession, like trimming expenses and cutting down on debts. Aside from preparing ourselves and our businesses, recognizing the early indications of an impending recession might spur governments to take preventive measures. To stimulate the economy, this may entail enacting economic measures like tax cuts, higher government expenditure, and lower interest rates. The impact on markets and investments. Because of these economic shifts happening, we both know how affected our lives and families are. As the US heads towards a severe recession, it's not just individuals who will be impacted by the economic fallout. A recession has numerous implications on the markets and investments as well. The stock market will have one of the biggest effects. Historically, the stock market has suffered during recessions, and this time is probably no exception. Investors' portfolios are therefore likely to experience a big decline. The most notable fall, according to experts, will be seen in sectors that primarily rely on discretionary expenditure, such as luxury products, travel, and entertainment. A recession, however, may not hurt other areas, such as the healthcare sector. Real estate and the housing market are also significantly impacted by a recession. During a recession, many individuals may resort to renting instead of buying a home. This can lead to a decline in the housing market. Additionally, for those who already own a home, a recession can mean a decline in home values, leading to a decrease in home equity. The commodity markets are also impacted by a recession. During a recession, the demand for commodities such as oil, gas, and metals typically decreases as companies shut down operations and reduce production. As a result, the prices of these commodities usually drop significantly. Policy responses and government intervention. The government steps in to play a crucial role in reducing the impact of a severe recession. They have a few effective strategies at their disposal, mostly fiscal and monetary policy, to revive the economy and prevent a recession from deepening into a depression. Fiscal policy is comparable to the nation's financial management strategy. When a recession strikes, people start spending more and paying less in taxes to stimulate the economy. This increase in government expenditure and the tax incentives it offers increase consumer demand for products and services, creating jobs and reviving the economy as a whole. Central banks, like the Federal Reserve, take part in monetary policy through their operations. To stimulate borrowing and spending during a recession, the central bank reduces interest rates. As a result, investing and growing become more affordable for firms and individuals, thus increasing the economy. Government action, however, may also come with dangers. It is possible to run up significant deficits and debts, which can lead to inflation and lessen the effectiveness of monetary policy. Excessive governmental meddling and regulation can also impede the free market, limiting economic expansion. Governments need to strike a balance between intervention and allowing the free market to function. Effective policy responses can prevent a severe recession from becoming a long-term economic downturn. But too much government involvement can lead to unintended consequences. In this time of economic uncertainty, individuals need to stay informed and take the necessary actions to protect themselves. The government alone cannot prevent or cure a recession, and it is up to all of us to be financially prepared and take proactive measures. Preparing for a severe recession. What can we do? Now we know all about that. What can we do? It is no secret that the prospect of a severe recession is daunting. However, there are steps we can take to prepare ourselves and minimize its impact. Here are some key points to keep in mind. The most important action you can take is probably to make sure your finances are secure. This involves building an adequate emergency fund that could see you through challenging times. Financial experts advise keeping at least 6 months' worth of expenses in reserve. A critical examination of your debt and assets is also essential. Now is the time to pay down any high-interest debt you may have quickly. Prioritize needs above wants and limit discretionary spending when you can, considering selling off any assets that are neither necessary nor profitable as well. On a personal level, there are many steps you can take to hedge against a recession. For instance, invest in defensive stocks that provide stable returns, even during an economic downturn. You can also consider alternative investments, such as precious metals or real estate. It's also essential to protect your job security. Keep your skill set updated, network extensively, and cultivate a strong work ethic. These qualities will help you stay gainfully employed even during a recession. So, that's everything you need to know. Well, at the least. This crisis demands a coordinated global response, where individuals, businesses, and governments alike must take action to mitigate its impact. The severity of the situation cannot be understated, and we must act now rather than later. However, amidst all the gloom and doom, there is a silver lining to this situation. We have the opportunity to be financially prepared, take measures to protect ourselves, and encourage global cooperation. Thank you for watching. If you like this video, please don't forget to give a thumbs up, comment, and hit that notification bell so you don't miss out on our following videos.